Everyone, it has been a while, right?
Yeah, it's been 2 weeks.
Yeah, markets have just been chopping and drawing down, and everyone's been crying in the crypto space.
Oh yeah, crypto was. I think the last 2 weeks have been quite hard on crypto. We saw a brief run of Bitcoin back to 125, 126 even, and well, since that day, it's just been down and down and down and down.
Yeah, it's just been crapping the bed nonstop.
I'm actually quite curious as to why Bitcoin is going that far down because, well, it's typically a indicator of risk on assets, but the market, otherwise the NASDAQ, while it did have a downward turn, it bounced back and is in this sort of unstable equilibrium moving on forward. So I do wonder why there is such a big deviation from the NASDAQ and Bitcoin this time around.
Yeah, so I've been giving a lot of thought on this to try to understand what's happening here. And I think that we are moving to an environment where you should take some risk off the table. So during the first, pullback, the first major pullback on these assets, the Trump administration basically talked about China, talked about how, the Chinese were restricting rare earth mineral exports. And in retaliation, Trump was basically going to say 100% tariffs by November 1st.
Right.
Now, as we've seen from before, the trade is likely a taco trade where he chickens out. But that's the thing, right? Markets should have expected that was going to happen and shrugged it off, but they didn't. Now, why is that? And I think the answer to that question is that the market is sniffing out some sort of deflationary environment, and it's less resilient to these tweets and is less resilient to any new shock that's happening moving forward. We got some other news over the last week in regards to banking. So with that stuff with Trump and the tariffs, the market was recovering, but then afterwards it got slammed again because there was a regional banking crisis that was brewing. So just to kind of give you an idea for listeners there were two specific financial institutions. Specifically, one is called Jefferies Financial Group, and basically what's going on there is that they were very exposed to certain companies, particularly a auto conglomerate, an auto parts conglomerate, and that conglomerate basically declared bankruptcy in September, and they announced that these banks are very exposed to the subprime auto industry, and there is some sort of credit event happening. So when you go on the ticker KRE, which is the regional banking ETF, it's been basically shitting the bed because there's a lot of fear going on that there is some sort of over tightening by the Fed, and the first sector that is highly sensitive to that is the subprime industry.
Mm-hmm. Regional banks, and then obviously the subprime industries, which feed into regional banks, which then obviously, to the transitive nature of the market, go towards larger banks and to the wider economy in general. And it's not to me, it's not a huge surprise because we have been seeing, the U.S. credit debt for the consumers. We're seeing the housing debt. It's all been, moving up and up and up at quite a steep trajectory. It is surprising to me a little bit that the regional banks are being so affected. That if credit event is happening now, because we're kind of, if the risk on assets have shown anything, we're kind of at, maybe a tail end, but definitely, on the trend of all-time highs. So, what is really happening here, and why are we really being affected by, the credit event now of all things?
Yeah, so there's some fears already happening. There's been a lot of complaints about AI circular financing.
Mm-hmm.
We kind of talked about that.
Yep.
Off the podcast, where you have companies like Nvidia announcing deals with OpenAI announcing deals with Oracle, right? And then like that jump in market cap is being leveraged to invest in the next company, and it all goes in circles. So there's a lot of fear that the AI boom is becoming an AI bubble, which might lead to AI burst.
Mm-hmm.
So I do think that some sort of correction is necessary to help unwind some of the euphoria and to unwind the nervousness that the market and retailers have kind of developed after, I don't know, it's been like two years since, the AI boom really started.
Yeah.
So there's just been a lot of leveraged bets on not just like assets like QQQ, but there are also leveraged bets on Bitcoin.
Mm-hmm.
Why does Bitcoin go from like 108 to 127 in like 3 days? Well, it's because these guys are leveraged, right? Well, now they're being flushed out, and there's less buyers on the table who's willing to volunteer to become exit liquidity.
Yeah.
Right?
Yeah.
Frankly speaking.
Yeah.
So we're seeing more of that reluctance now, and people are starting to tell themselves, hey, maybe I should wait a little bit longer before I step in, because the market isn't like euphorically going up anymore. So couple that, whole thing with the government shutdown that's been ongoing for more than 2 weeks now, there's just been a lot of uncertainty happening, connecting to how, we've been trading. I had to close my meta calls at a slight loss because, I kind of sniffed the writing on the wall, where I think we're moving on to a risk-off regime. There's a lot of uncertainty, and we even have earnings like in the next 2 weeks or so for tech.
Yeah, we have quite a few earnings actually. I think we should probably dive into that as well. But I just want to say we're in quite a very unique scenario where, well, number one, we have the government shutdown. Number two, we have trade tensions, even if they might be, just surface level trade tensions, but between US and China. China also did retaliate to the US by adding tariffs on, or they refusing to buy their soybeans. They use the soybeans. There's like a $20 billion export to China. So there are things that are happening on that end. Then of course we have the lack of data, which is coming from the government shutdown. We have the FOMC meeting coming up in 2 weeks, where a rate cut is expected. We had Jerome Powell speak last week, and I think he's been quite dovish. I think this is one of the most dovish speech I've seen him do, alongside I think other central bank directors around the world. And I think everyone is kind of in the environment of, hey, maybe it's time to cut across the world. Not across the world, to be fair. Across, I think it's the UK who said that as well. So across the more Western hemisphere. So we're kind of in that scenario. There's quite a bit of news happening. We also have, the regional banks. They're going through their credit crisis potentially. And so really, we're getting mixed signals. On one side, we're like, hey, tech is doing really well. We're spending all this infrastructure. It's going to have productivity, huge productivity returns, in the future. On the other side, we're in a very uncertain time, and on the other end, we might also be in a defensive time, given that the U.S. credit, the U.S. debt, the consumer debt, all been on the rise. So where does that really leave us? And I think personally, we have pivoted to the U.S. bonds at the moment. I think we
Yeah.
were definitely looking at gold because, well, the gold keeps going up year after year, month after month, day after day. To be fair, Friday was a red day, but if you look at this, the overall curve, you were joking yesterday that it's on a parabolic trajectory. Obviously, that leads us to believe it's not sustainable, the growth of gold. So maybe instead of gold, we did think the bond market looks like a far safer pivot, especially given that, well, there are rate cut expectations. Obviously, those are priced in, but I will let you talk about, why bonds might be the correct move in this current time period.
Yeah. So going back to gold, right? Yeah, it's been like on a rip, and it's basically parabolic now, like 90 degrees type of stuff. Is this considered a macro trade now? I don't think so. I don't think this is normal. I think that there are chasers who are now basically just putting on leverage, speculating bets, saying that some guy will buy gold off of them at a higher price. Now there's no sound logic to it, right? If you look at the fact that in 2022, during the great inflation crisis that we recently experienced for the last couple of years, when inflation was at 6 to 9%, gold was going down, or gold was chopping. It wasn't actually doing well. But now you're telling me that omega hyperinflation is on the way? Like, that doesn't make sense, right? So where's the logic, right? Like if you look at our anchor system, we've been having oversold signals every two like weeks or something, and it just hasn't been respected. That is not normal.
Yeah.
Do you know, like for listeners out there, let me tell you what type of assets that I notice where these signals aren't respected. Meme companies. So companies like OKLO, right? ASTF, Rocket Lab, right? Like companies that you wouldn't probably put your retirement savings in because they're going up 20%
Every day,
possibly.
Yeah.
And then go minus 10% the next day.
Yeah.
Right? Those companies are behaving like gold. Is that normal? I don't think so. So when you look at this quote unquote risk off asset, I don't think it behaves like that anymore, but this risk off asset, and you compare it to bonds, like TLT, for example, you look at the ratio of TLT and gold. TLT is looking more favorable every day if we keep seeing these green Hulk candles like every day on gold. Because you have real buyers, real macro buyers who want to pivot off a risk on, and they're telling themselves, should I chase gold, which is at 80 RSI?
Yep.
Or should I buy something more under value or fair price, like bonds right now? And like you, I have also pivoted into bonds from risk on assets, because I think I see the logic in that. If I want to park my cash somewhere, it's not going to be in something that's been going up 100% in the last 2 months. It just doesn't make sense.
But I think while I am mostly in bonds, I've still left a small position open to the NASDAQ and to tech, because, well, we're in quite an uncertain period where the volatility is just the implied volatility is just growing crazier and crazier. But we're also in a period where the Q3 tech earnings are out. So if I just take a look at some of the earnings from what I'm tracking, you have Netflix, you have Tesla, you have Celestica, which is an AI company that's from Canada. You have Google, Meta, Alphabet, Microsoft, Coinbase, Strategy, Apple. These are all upcoming in the next 14 days. That's a pretty big portion of tech, and it's all going to be on Q3. What has been your perception of is it Q3? Yeah, it's Q3 tech earnings. So yeah, it's Q3. What's been your perception of Q2 and Q3 so far?
So I think with with the growth that we experienced, especially with the AI infrastructure boom, growth has been pretty strong, really resilient. Given the fact that we have an administration that's booting people out and has been distorting consumption patterns with tariffs. So with tech companies like Meta and such breaking and exceeding expectations in the last quarter, I think they've been doing well. I do think that with this new shift in environment where things are more risk off, if they underperform just a little bit or they outperform but they don't outperform by a significant margin,
Mm-hmm.
then markets can throw a tantrum. And we've seen that, right? Like
Yeah.
we've seen companies that beat estimates, and because they don't beat estimates by a ridiculous amount, they still go down. Because a lot of these companies get front run leading to the earnings where everyone makes a bet saying, oh, it's gonna beat, but it's gonna be very great, but it doesn't. So I'm worried that that type of euphoria will happen in the leading 2 weeks. And because the market is already so much less robust to shock events like tweets and sniffing of a credit event, it is more sound to take some money off the table if you're green at the moment. Yeah, if there's any indication that risk off is happening, if you look at the overnight futures in the last couple of days, I would regard those as tremors because you see like minus 300 points on the NQs at like 4 a.m. in the morning, but then it recovers, right? How many times is it going to do that before it actually, draws down and there are no buyers?
Yeah, and,
I feel like,
and to be fair, even Anchor system, it's throwing away, it's throwing orange flags. It's throwing negative predictions that despite the price action looking like stabilizing around a certain price point, consolidating around a certain price point, it's been throwing short-term negative predictions. So let's see, and it's pretty right, these predictions, that we look at it in a more holistic long-term sense. So it is something that we're looking at as well. And I also think that in Q2, Q3, again, that in this time period, a lot of growth actually hasn't necessarily been in AI itself. It has rather been in AI infrastructure. So we saw a lot of it in data centers. We saw it in electricity. I think that's something that's being eyed by quite a few people on the market to look and see how it develops in the future. And I don't know. I feel like out of the companies that I expect to do well are those who are either in the data center market itself or at least heavily linked to it. But as you say, maybe in this environment, are they going to be beating out their earnings by a substantial margin? Or will it just be a met expectation, which will be met by a market disappointment? And we all know how that turns out.
Yeah, so I think it's important that I start hedging your bets now because you're seeing NASDAQ chop. When NASDAQ chops, it chops because it's either consolidating or the direction of it is uncertain due to lack of euphoria. So when we look at, the NASDAQ over the last, I don't know, like since summer, right? Rarely does it chop and stay flat for maybe more than a week. And if we start seeing that chop extend itself longer than what we've seen in the past over the summer, you'll probably get a feel that something has changed. Because usually it dips, touches the KRM line, and then it smashes back up, right?
Yeah.
That's usually how it works. But it's not. In fact, when we look at NQ, it touched our blue zone, and it's just been hobbling itself over the last 5 trading days. Yeah. Which is astonishing because usually it's very bullish.
Or so even more chaotic, right? You see it go up and down, but seeing it just stabilize is actually very rare.
Yeah, and that doesn't bode well either, because you're seeing these long whiskers, specifically for the upper whisker, right? What is that saying? Well, it's saying that when you're looking at those candlesticks, the price gets bid up that high, but there's no buyer, so it goes back down.
Yeah.
And you've just been seeing that wick over and over and over again. And what I'm worried about is if the candlestick actually goes down, that whisker that we see at the bottom, that's not going to be a whisker anymore. It's going to be a solid candle. So,
yep.
So that's my biggest worry. And I want to see where direction is. There's no shame in taking money out when you're uncertain of what the direction is. You can chase this when momentum's back, but you shouldn't force yourself into a position where you're buying something because you want to take advantage of an opportunity that you haven't seen in a while. This is not opportunity. This is called fog of war, and you actually don't know what direction you're in right now.
Very, very apt description. Fog of war. I like that. And it really does feel that way. But
it does.
But with the downward pressure. Natural downward pressure.
Yeah, it is. It is. And I now want to pivot to what we kind of should expect in the next 2 weeks. We talked about earnings, right? But I think the most important thing we should be discussing now is what we expect from an FOMC.
Yeah. I mean, with the FOMC, we heard him talk. Was it Tuesday of this week? I think it was Tuesday. We heard him. Yeah. We heard him talk at a press conference. He was saying that, well, for the labor market, despite the government shutdown, that they have reliable, or at least what they can consider to be good quality sources for information. And they had existing data, which was all showing a picture. And with these supplementary data sources, they kind of do say that the labor market weakening is real, and is still continuing. So I think rate cuts are still being priced in, at least one rate cut in October and one rate cut in December. And he did say that inflation data obviously was a bit harder to measure, that they didn't necessarily have, while they do have secondary sources, it's not necessarily as clear. But from his speaking, he was saying, hey, inflation is actually less of a worry right now. And so I really do think we're like a 70% chance, 70% chance of a 25 basis point cut, with an expectation of another cut potentially at the end of the year.
Yeah, so markets are, despite the lack of government data, they've been pricing in a cut for October. I'm starting to lean that way too. I think that, before these events happened, before the lack of market resilience was shown, I felt that the Fed would be more on the hawkish side, and they'll be cautious and wait for a bit before getting data. But I think that based on his comments of trying to end QT, trying to, massage the expectation that they're going to take it easy on the financial markets, I'm not going to be surprised that they're going to follow the probability curve. Because think about it, right? When you look at the implied curve prices in cuts that we know that are already going to happen. So when someone says something like, markets are going to go up when they cut on October, I find that a little bit ridiculous, because that's already been priced in. Now, I think that if on FOMC day, when markets go up because of some Fed-related news, it's going to be that the fact that the Fed is projecting an extra cut that the market has not priced in. So, given the current outlook right now, what I think is going to happen is they're going to follow market expectations. Because if they don't, I think TLT will just continue going up, because the market will get even more jittery, and I think there's more disinflation down the road, right? With the bigger risk that the Fed is over tightening the markets, leading to a potential recession risk. Or if they do cut, I think markets will be, a little bit there'll be content, but they won't be euphoric. But I think my biggest worry is that if they don't cut, the markets will puke, but you'll see that being reflected in bonds going up because there's more fear of recession.
Yeah, I definitely feel that way too. I mean, just the fear of recession. It's not actually. I haven't necessarily heard that being tossed around too much in like the very, very long, and not necessarily long term, but in a while. At least not in the American markets. But I think we're definitely fearing that a bit now, aren't we? I mean, I don't think it's too likely, but I mean, we're seeing that the quality of life is just getting harder and harder to maintain, while all the other magic numbers, GDP, etc., keep going up. So, yeah.
Like just going back to the discussion, right? You ask how come recessions the word recessions are being thrown around, and I think that's like saying, well, how come no one's buying bonds? So when you look at the bond trade, bonds has been just in the trash can for last year, right? Since Trump has been inaugurated and elected and such, bonds have just been taking a dive. And because of its reputation related to gold right now and Bitcoin, it has lost its luster as a store of capital. So I think when people say, hey, let's buy gold, they're buying gold because of inflation risk and government uncertainty, not because of actual recession risk. Sure, yeah, it could be recession risk, but I don't think that's the main reason. People buy gold mainly to hedge their dollar value, not because of recessions. But people buy bonds when they want free, risk-free returns, and they expect that the Fed is going to cut hard, which the market may not have priced in yet. So by proxy, if people aren't talking about the bond trade, they're also not worrying about the recession. But and vice versa, if they're not talking about recession, they also aren't giving a second thought to bonds. And I think that's where we can arb that value in our trades, because if bonds are so overlooked, what happens when they're no longer overlooked? You'll see that reflected in the values.
Yeah.
And one final thing I want to take a look at is just if you pull up the TLT GLD ratio, you see just how favorable the ratios are.
Yeah. We've been seeing that ratio dive for months on now here. I'm looking at TLT divide by gold.
Yeah. So what you're seeing is that on Anchor, it's basically telling you, hey, like you're very oversold, right? In terms of the ratio, that is almost unnaturally so. So, if this continues happening, at some point there's going to be a rebound, right? And that rebound has not been priced in yet at all. And I don't even think markets are even looking at it. Bonds have been performing well over the last 1 to 2 months. It has recovered robustly. But if things continue the way it is, people are going to need insurance. And that insurance is going to be TLT and other bond assets.
Yeah, I would hope so. I mean, what else is there, right? I mean, for the gold market at large, very, very few other risk-free havens. And yeah, if things continue as they are, especially in the U.S. markets. Yeah,
pretty much, right?
I mean, there's always the worry of the U.S. losing, its central currency status, as well as losing its safe haven status. But I mean, I agree it's been weakened, but I don't think it's made the U.S. less dominant for now. So I think the U.S. bond markets are still fine. They're still going to be fine, at least for a few years to go. So I don't think that's necessarily a short-term risk if you're pivoting to the bond market for now.
Yeah, frankly speaking, I don't think any system can replace it. Just taking a tangent here, you're looking at a, $40-50 trillion liquidity market, right? There's no market on the planet that is the size of the U.S. Treasury market at all. Nothing can replace it. Who can dump $1 trillion of their bond assets that no one wants and expect the market to not crash. I think the U.S. Treasury market is the only market that even has the possibility of being able to pull that off. And there is no capital control restrictions. So you can do that if you literally want to right now. Like China can market order its bonds right now. And nothing can stop the U.S. from doing it, right? From them doing it.
Yeah.
But you cannot say the same about the other markets. You know, people talk about Chinese bonds. Okay, so you think your Chinese central government's gonna let you dump $1 trillion of Chinese bonds, like right now?
Yeah, that's not happening. Yeah.
Your question rate? No, I don't think so. Do you think they're gonna let you borrow that much to have that much leverage over them? I don't think so.
Yeah.
So if you're looking at China, you're not really getting anywhere in terms of financial market maturity, because it simply is not compatible with what we need, right? It's not liquid. You're looking at Europe. Europe is a complete, basically in shambles now. Their government, France, can't even get their financial cards in order. So that's been ongoing. And there's always been risk of, will the euro survive next year? So I'm not too confident that they're going to be able to replace the US dollar system. And then you have Japan, which crashed like 30 years ago, and they're still going. So all these major competitors don't have a currency that is remotely close to be able to size this market. Like, most people talk about why the US debt is so big, but they don't talk about the benefits of having a large US debt. And it's that if your debt is this big, it means your secondary markets is just as big. So people are willing to anchor their wealth onto your debt because you can borrow so much. No other country can do that.
Mm-hmm.
Maybe India, like 100 years from now, but who knows?
We'll find out. We'll find out as
Yeah.
things develop. Obviously, there are also currents there. You have some big governments trading who are moving away from the U.S. dollar to use whatever other currency or barter that they can.
But that's a magic word, right?
Yeah. Barter. Yeah.
Barter.
It's not a hedge, right? It's not a safe haven to just dump your money and get some money back. So.
Yeah, exactly, right? Like, imagine you're Vietnam and you're exporting, and you got to export to like South Korea. Do the South Koreans want to keep the Vietnamese currency, or vice versa? I think for the business merchants there, the thing is a waste of time. They just want to settle in USD instead because it lubricates the trade. So, with that being said, while I think bartering and all that medieval stuff is possible, I don't think it can be operated on the scales of trillions, because that's with trillions of trade, you're getting friction, which can cost you hundreds of billions. So long-term wise, it's not very capital efficient. You need some sort of master currency to hedge for all these friction.
I mean, well, time will tell, because things can change. I wouldn't say no to the US will just keep being the biggest market. There might be other alternatives, but we're safe for now. We'll probably end it there. I think we're getting into a nice debate that could probably last for another hour, so we'll probably have to stop there. Well,
so I think that's it, right?
Yeah. Well, let's wrap it up for today. A long podcast, probably because we did take a 2-week break. So we're back. We're here to stay. And see you guys around. Thank you so much for watching. If you have any comments, questions, concerns, please leave them as comments in the video. Thank you.